So, things like money supply changes, historical monetary policy, fiscal policy, things like that, historical equity valuations, interest rates. And then, of course, I tie that into more up-to-date information. So what equity markets are doing, how different sectors are performing. I paid a lot of attention recently to currency markets because the dollar is such an important part of where we are in this kind of multi-year cycle. So I tie a lot of those kind of more timely data points into this like longer term historical context. Well, I think one thing I do is just because, I am still pretty young, and I guess maybe this makes it easier to kind of always change, thoughts as it comes in. But aside from that, I try to follow people I agree with, disagree with, from totally different backgrounds, so that I'm always kind of aware of the counter argument, and that I'm able to articulate their argument in a way that, that I think that they would agree with. That kind of gives it the credit that it's due. And then just from, taking a numbers-based approach to things, and kind of, every time I make an argument or make a, some sort of economic outlook, I try to tie it into data in some point. So if I don't have the data on my side, I inherently have to go a different direction. So a lot of times I'll start with a hypothesis that I think something's correct, but when I go about trying to justify it, I find that I can't, and then therefore I have to. Sometimes I end up taking the alternative view, or that the outcome is simply, indecisive at the time, and therefore my original thought was most likely not grounded in facts. And so by having that really kind of enforced kind of numbers-based thing for every point I make, that really kind of inherently gets you more towards truth whenever possible. It's still always, of course, you can interpret things wrong. You could be looking at the wrong data set. So it's always important to just keep questioning where you could be wrong, what are the risks. I think that's one of the biggest risks in the industry, because the investment management industry attracts really bright people, and so one of the biggest traps they can fall into is not that they're not intelligent enough. It's falling into the trap of being prideful, or just not being quick enough to iterate, or to realize, to be able to strongly articulate an alternative view. Oh, so part of it is making sure you define time horizons, because a lot of times people have different opinions on how something's going to play out, and they just haven't taken the time to sort out their time horizon. So you could have someone with a long-term view talking to someone with a short-term view, and they're arguing past each other about what they think is going to happen. So part of understanding whether or not you were right or wrong about something is understanding your initial time frame, because if your initial time frame was unclear, then it's at what point do you judge whether or not you were right or wrong? And so I think having that kind of predefined time frame helps you kind of go back and reassess things objectively. And then aside from that, just starting from first principles all the time, so starting from raw data and then layering narratives on top to help contextualize that data, add insight to that data, rather than starting from a narrative or starting from an idea and then finding data to continually back that up. I think so. I think, for better or worse, I mean, my journal is incredibly public because my work centers around writing. And so I have, timestamped newsletters. I have timestamped premium reports. And so the archives are available, so I can go back and look through them. Sometimes if I'm updating a view, I'll go back and look at what I wrote about that sector or that particular type of company before to see, sometimes it played out. I see if that thesis is still correct. Sometimes it did not play out, so I see why not. So, for example, a couple months ago, I was reviewing one of my past energy stock picks, and just going back. Of course, that out of all the stocks this year, that would have been one of the worst ones to go into the year with. And so I basically went back and reviewed, like, okay, is the fundamental thesis still good? How much of the downside in that move was due to kind of just the valuation going down versus the actual fundamentals, and just kind of going back and having that archive available helps. And so if I didn't have that, I would be more interested in just kind of private journaling, just to go through it and make sure I understand why I made investments, what my thought process was at the time. Yeah, so I think part of it is understanding what you have an edge in. And so if you try to do everything equally, you're going to be pretty much mediocre at everything. Whereas, kind of defining your own strengths and weaknesses and making sure you're very clear about what you're trying to do makes it easier to filter out information. So, for example, with myself, because I have a long-term view for most of my investments, I can filter out most of the short-term noise, a lot of the high-frequency stuff, and that kind of keeps me focused on data that will affect the long-term outcome of the investments I make, rather than kind of trying to manage both the long-term and the short-term simultaneously. So I think that's the biggest thing, is just kind of making sure you know what your target is, so that you can disregard information that doesn't strongly, result in whether or not you're going to hit your target or not. To some extent. So because my background's initially in engineering, I think of things for the most part in terms of control engineering. And so kind of taking into account kind of a framework for all the inputs and outputs, and then having feedback loops, so and response outcomes. So for example, if X happens, then what is the policy response Y that's likely? And kind of also finding if else situations. So like we know that an outcome is going to happen. We don't know specifically what direction it's going to take, but we can form very clear things like if it goes this way or this way, what are the things that are almost certainly likely to happen from either of those two outcomes, and then therefore you know what to do ahead of time if that outcome occurs. So kind of having that, trying to find points that are binary wherever possible. Yeah, I think so. I think, and there's two kind of broad separations to that question. So one is taking profits and things like that. I look at a variety of overbought indicators, oversold indicators, to try to see where price would affect something, where I want to take some profits off the table. Like I might trim my tech stocks, I might trim my copper stocks because they've done very well, whereas I might stick with some of my things that have lagged a little bit this year. On the other hand, the main thing about determining whether or not you were right or wrong, at least in the type of investing I do, is watching the fundamentals outcome. So, the quarterly reports, the annual reports, and if a company is just not growing at the rate I expected, or if they announce certain bad news or a change in strategy or something that didn't align with my initial envision of how that investment is going to play out, then I have to go back and reassess and just kind of start over and say, okay, is this attractive at the current price level, the current fundamentals, or is it deviated so far from what I'm expecting that it's clearly time to cut losses and move capital to somewhere else? Yeah, so it's one of those things where now that the Federal Reserve is over a century old, we have over a century of historical data for how they behave, and so uh, one the context I found most useful for understanding their actions is the long-term debt cycle. So that was popularized by Ray Dalio, and then I've incorporated that heavily into my own research, done my own kind of rebuilt my own models, for that, and kind of look at it separately, and. So the concept there is that you have the short-term business cycle, you have the 5 to 10 year credit cycle, boom bust cycle, and so during that process, you get more and more leverage building up in the system. Usually, you have the Federal Reserve trying to raise rates, and then something happens. Either the rates themselves eventually kind of squeeze the system, or you get some sort of external shock, and then you get a recession, a deleveraging event, and then policymakers come in, they cut interest rates. Usually, you also have fiscal response as well. And so that short circuits the deleveraging event. And so leverage starts to go down, but it never goes back all the way to where it was at the beginning of that cycle, and then starts to build up from there. And so when you string multiple of those short-term business cycles together, you get the long-term cycle, which is basically that you get higher and higher debt as a percentage of GDP,